First, learn and educate yourself. Buffett emphasizes continuous learning and research. Start by educating yourself about investing, finance, and various industries. Imagine you're interested in investing in the technology sector. You start by educating yourself about the basics of investing, understanding key terms like stocks, bonds, dividends, and market capitalization. You also learn about financial statements, such as balance sheets and income statements, which provide insights into a company's financial health. Next, you delve into the technology industry. You study the trends, innovations, and challenges within the sector. You might read about emerging technologies like artificial intelligence, cloud computing, and renewable energy, as well as the major players in these areas. As you learn, you might come across a company that specializes in renewable energy solutions. You begin researching this company's financials, looking at its revenue growth, profitability, and debt levels. This research helps you assess the company's potential for long-term success. Buffett's emphasis on continuous learning means you don't stop at a single research phase. You stay updated on industry news, technological advancements, and economic trends that could impact your investments. This ongoing education helps you make informed decisions and adapt your investment strategy as needed. In this example, the process of learning and educating yourself involves acquiring knowledge about both investing principles and the specific industry you're interested in. This knowledge empowers you to make well-informed investment choices, just as Buffett has done throughout his career. Second, value investing. Focus on value investing, which involves finding undervalued companies with strong fundamentals and growth potential. Imagine you're researching potential investments in the retail industry. You come across two companies, Company A and Company B, both operating in the same sector. Company A, this company has a strong brand presence and a history of steady revenue growth. However, its stock price has recently experienced a significant decline due to temporary market sentiment and concerns about the retail sector as a whole. Company B, this company is also in the retail sector, but its stock price has been consistently high due to market hype. It's often seen as a trendy stock, even though its revenue growth has been volatile, and it doesn't have a strong history of profitability. As a value investor, you would be more interested in Company A despite its recent stock price decline. You recognize that the company's strong brand, consistent revenue growth, and solid fundamentals indicate it may be undervalued by the market. This could be due to short-term factors affecting the stock price that don't necessarily reflect the company's long-term potential. On the other hand, Company B's stock price might be inflated due to market exuberance, even though its actual financial performance doesn't justify the high valuation. In this example, value investing involves recognizing the disconnect between a company's intrinsic value, based on its fundamentals and growth potential, and its current stock price. By focusing on undervalued companies with strong fundamentals, you aim to invest in assets that have the potential to provide good returns over the long term. Warren Buffett's success as a value investor is attributed to his ability to identify such opportunities and invest in companies that he believes are trading below their true worth. Third, long-term perspective. Adopt a long-term perspective, avoiding short-term market fluctuations and aiming for sustained growth. Imagine you invest in a company's stock with a long-term perspective. This company operates in the renewable energy sector and is working on innovative technologies to harness solar energy more efficiently. In the short term, the company faces challenges. A sudden increase in the cost of raw materials leads to a dip in its quarterly earnings. Additionally, there's a general market downturn due to economic uncertainties. A short-term investor might panic and decide to sell their shares as soon as they see the dip in earnings in the market downturn. They're concerned about losing money and want to avoid further losses. As a long-term investor, you take a different approach. You understand that short-term fluctuations are common and can be influenced by various external factors. You focus on the company's fundamental strengths, like its innovative technology, dedicated research team, and strong commitment to sustainability. Instead of selling, you stay invested and even consider buying more shares while the price is lower. You believe that the company's long-term growth potential remains intact despite the short-term challenges. You're confident that as the solar energy sector gains prominence and the company's technology matures, its value will increase over time. Over the next few years, the renewable energy sector experiences a boom due to increasing environmental concerns and government support. The company's innovative technology proves to be a game changer, and its stock price gradually rises, providing you with substantial returns on your investment. In this example, adopting a long-term perspective allowed you to weather short-term market fluctuations and benefit from the company's sustained growth. Warren Buffett's approach of holding on to quality investments through market ups and downs is a testament to the success of this strategy, as it avoids making hasty decisions based on short-term volatility and focuses on the bigger picture of sustained value creation. Fourth circle of competence: stick to industries and companies you understand well. This helps you make informed investment decisions. Imagine you have a strong background and expertise in the healthcare industry. You've worked in pharmaceutical research and have a deep understanding of how drug development, clinical trials, and regulatory approvals work. One day, you come across an exciting investment opportunity in the technology sector. This opportunity involves a company working on cutting-edge artificial intelligence applications for healthcare diagnostics. While the technology aspect intrigues you, you realize that you lack the in-depth knowledge required to fully evaluate the company's technology, market potential, and competitive landscape. Instead of investing in the technology company, you decide to stick to your circle of competence and focus on healthcare-related investments. You understand the nuances of the industry, how regulatory agencies operate, and the factors that drive success in this field. With your healthcare expertise, you identify a pharmaceutical company that is developing a novel treatment for a rare disease. You analyze its clinical trial data, understand its potential market size, and evaluate the competitive landscape. Your deep understanding of the industry allows you to make an informed investment decision based on solid analysis and knowledge. Over the years, the pharmaceutical company's treatment gains regulatory approval and proves to be a groundbreaking solution for the rare disease. The company's stock price rises significantly, resulting in substantial returns on your investment. In this example, sticking to your circle of competence, healthcare industry, enabled you to make a well-informed investment decision. Warren Buffett's advice to invest in industries and companies you understand well aligns with this principle. It ensures that you have the knowledge and expertise needed to assess opportunities accurately and make confident investment choices. Fifth, margin of safety. Invest with a margin of safety, buying stocks at a price below their intrinsic value to mitigate risks. Imagine you're considering investing in a company called XYZ Incorporated. It operates in the consumer goods sector and has been performing well with consistent revenue growth and healthy profits. After thorough analysis of the company's financial statements, competitive position, and growth prospects, you estimate that the intrinsic value of XYZ Incorporated is $50 per share. However, the current market price of XYZ Incorporated stock is $60 per share. Recognizing the importance of a margin of safety, you decide to apply a 20% margin of safety to your intrinsic value estimate. This means you'd only consider buying the stock if it's priced significantly below its intrinsic value. In this case, your margin of safety would be $50 times 0.20 equals $10. With the market price at $60 and your estimated intrinsic value at $50, the stock doesn't meet your margin of safety requirement. Despite the company's promising performance, you decide not to invest in the stock at this price. You would prefer to wait until the stock price falls closer to or below your calculated intrinsic value, providing a cushion against potential miscalculations or market fluctuations. Several months later, due to a broader market downturn and temporary negative sentiment in the consumer goods sector, the stock price of XYZ Incorporated drops to $45 per share. At this point, the stock price aligns with your calculated intrinsic value and meets your margin of safety criteria. You decide to invest in the stock, knowing that you've purchased it below its intrinsic value, which provides a buffer against unexpected market developments. Over time, as the market sentiment improves and the company continues to perform well, the stock price appreciates to reflect its true worth, resulting in a favorable return on your investment. In this example, applying a margin of safety helps you mitigate risks and make investment decisions that align with Warren Buffett's value investing principles. It ensures that you're buying assets at a price that provides a cushion against potential uncertainties and inaccuracies in your valuation calculations. Sixth, consistency. Consistently save and invest a portion of your income, benefiting from compounding over time. Imagine you're just starting your career and you decide to follow the principle of consistency by setting aside a portion of your monthly income for savings and investments. You earn $3,000 per month after taxes. You decide to save and invest 20% of your monthly income, which amounts to $600. You choose a mix of low-cost index funds and individual stocks that align with your financial goals and risk tolerance. Over the years, your consistent monthly contributions of $600, along with any potential investment returns, start to compound. Compounding means that your investment gains also earn returns, leading to exponential growth over time. After the first year, your investment portfolio has grown to $7,500, assuming a 7% average annual return. After 5 years of consistently saving and investing, your investment portfolio has grown to around $42,000, even without accounting for potential salary increases. At the 10-year mark, your investment portfolio has reached approximately $100,000 due to the compounding effect of consistent contributions and investment returns. As you continue to save and invest consistently, your portfolio continues to grow substantially. By the time you reach retirement age, your disciplined approach has led to a significant nest egg that can provide financial security and support your retirement goals. In this example, the principle of consistency involves committing to a specific savings percentage and consistently adhering to it over the long term. This approach takes advantage of the power of compounding, where your investments generate returns that, in turn, generate more returns over time. Warren Buffett's emphasis on consistency aligns with the idea that small, regular contributions can lead to substantial financial growth over the years.